Silver's $120 return. Why major banks are still bullish after the crash. January 30th, 2026. Silver touches $120 per ounce. 48 hours later, it's at $78, a 35% collapse. The worst precious metals crash in 45 years. Every retail trader panicked. Every forum screamed bubble burst. Every headline declared the rally dead. But here's what nobody noticed. Citigroup didn't change their forecast. JP Morgan didn't revise their targets. Bank of America called it temporary dislocation. While physical silver in Tokyo traded at 60% premium, the paper market said it was worthless. Something doesn't add up. And what the major banks know could rewrite the next 12 months of global markets. The question isn't if silver hits $120 again. The question is, what do they see that you don't? Welcome to IWNAG, where we analyze precious metals markets with the precision they demand and the respect they deserve. If you followed global markets long enough to remember when financial analysis meant more than headlines and hype, when strategy mattered more than speculation, then you're in the right place. We'd be honored if you'd subscribe to this channel, not with a click-hungry plea, but with a genuine invitation. If strategic economic intelligence matters to you, join us. And we're curious, from which corner of the world are you watching this analysis today? London, Singapore, New York, Dubai? Let us know in the comments below. Understanding where our audience stands helps us serve you better. Now, let's examine why the world's largest financial institutions are still bullish on silver after the worst crash in nearly half a century. On January 30th, 2026, silver reached a price that seemed impossible just months earlier, $120 per ounce. Traders across the world watched their screens in disbelief. Some celebrated. Others hesitated, sensing something unstable beneath the surface. They were right to hesitate. Within 48 hours, the price collapsed to $78, a 35% destruction of value in less than 2 days. Fortunes evaporated. Margin calls flooded trading desks. Panic spread through electronic markets like wildfire through dry grass. The financial media declared it predictable. The bubble finally burst, they wrote. Silver's rally was always unsustainable, analysts explained on television. Retail investors who had bought near the top watched their accounts bleed red. But something strange happened in the days that followed. While everyone expected the major banks to revise their forecasts downward, they didn't. Citigroup maintained its target of $100 by March 2026. JP Morgan kept its gold forecast at $5,000 to $6,000 per ounce. Gold was already trading at $4,900. Bank of America released a brief statement calling the crash a temporary dislocation. Not a fundamental repricing, not a market correction, temporary dislocation. For anyone paying attention, this created a disturbing question. Why would the largest financial institutions on Earth, institutions with access to global order flow, vault inventories, and industrial demand data, maintain bullish positions after the worst precious metals crash in 45 years? The answer wasn't in the price charts. It was in what happened in physical markets while paper markets collapsed. In Shanghai, buyers were paying 12 to 13% premiums above the official price. In Tokyo, the premium reached 60%. In Dubai, 40%. These weren't small discounts suggesting weak demand. These were massive premiums indicating desperate buyers. Think about what this means. When silver crashed to $78 on paper exchanges, physical buyers in Tokyo were paying $125 for actual metal. The crash hadn't reached the physical world. This revealed something most traders missed in the chaos. The crash wasn't caused by silver becoming less valuable. It was caused by too many traders using too much borrowed money. When prices dipped even slightly, automated systems triggered margin calls. Traders were forced to sell, not because they wanted to, but because their brokers demanded it. This created a cascade. Forced selling pushed prices lower. Lower prices triggered more margin calls. More margin calls forced more selling. The cycle fed itself until the most overleveraged positions were completely wiped out. But here's the critical distinction. This was a leverage event, not a value event. The fundamentals that had pushed silver to $120 hadn't changed. Industrial demand still exceeded mine production. The fifth consecutive year of this imbalance. Solar panel manufacturers still needed silver. Electronics producers still required it. Electric vehicle production still consumed it. China had classified silver as a critical material in 2024, implementing export restrictions. Supply remained geographically fragmented. Physical metal was becoming harder to move across borders. None of this changed when the price crashed. A market analyst named Nikki Shields from MKS PAMP said something revealing during an interview 3 days after the crash. "This is unheard of volatility," she stated carefully. "The market is broken. Not disrupted, not correcting, broken." She was referring to the growing disconnect between paper contracts traded on exchanges and physical metal traded in vaults. These two markets, which should theoretically represent the same asset, were behaving like completely different commodities. Paper silver crashed because traders with borrowed money were forced to sell contracts they didn't want to sell. Physical silver held steady because industrial buyers and national governments needed actual metal, not paper promises. This disconnect had been growing for months. The January crash simply made it impossible to ignore. For business leaders and strategic thinkers, this created an important framework for analysis. The question wasn't whether silver would recover. The question was which market would eventually force the other to adjust, paper or physical. History suggested an answer. Physical reality, given enough time, always wins. The major banks understood this. Their unchanged forecasts weren't based on optimism or speculation. They were based on something more fundamental, the understanding that what happened in January was a technical breakdown in market structure, not a collapse in silver's underlying value. By early February, silver had recovered to $87, still far below the 120 peak, but $29 above the crash bottom. The recovery happened quickly, too quickly for an asset that had supposedly lost its fundamental value. The pieces didn't fit the narrative of a bubble burst. Something else was happening, something the major financial institutions recognized, but the broader market had missed entirely. 3 weeks after the crash, a curious document circulated among institutional traders. It was a research note from Citigroup's Commodities Division. The date was February 18, 2026. The content was striking not for what it changed, but for what it refused to change. Target price for silver by March 2026, $100 per ounce, unchanged. This wasn't a footnote buried in dense financial language. It was the headline conclusion. After watching silver collapse 35% in 48 hours, after witnessing the worst precious metals volatility in nearly half a century, Citigroup's analysts had reviewed all available data and decided their original forecast still held. For anyone who understands how major banks operate, this was extraordinary. These institutions don't maintain forecasts out of stubbornness or pride. Research divisions are separate from trading desks, precisely to avoid this kind of bias. When fundamentals change, forecasts change. When assumptions prove wrong, targets get revised. The system is designed to be ruthlessly objective. Yet here was Citigroup, standing firm. They weren't alone. JP Morgan's precious metals team had published a bold forecast months earlier. Gold would reach $5,000 to $6,000 per ounce. In early February 2026, gold was trading at $4,900. Instead of celebrating being proven right, JP Morgan did something unexpected. They raised their target range, $6,000 to $6,500 by year-end. Their reasoning was technical but revealing. They noted that gold's rally was happening despite, not because of, strong economic conditions. This suggested the rally was driven by factors deeper than typical safe haven demand. Structural factors, systemic factors. And where gold goes, silver typically follows. The gold to silver ratio, a measure watched closely by precious metals analysts, suggested silver was still undervalued even at $87. Bank of America took a different approach. Rather than updating price targets, they published an analysis of what they called the paper-physical bifurcation. The term was deliberately clinical. It described a market where contracts and actual metal had become, in their words, functionally separate assets. Their conclusion was stark. One of these markets would eventually be forced to adjust to the other. Either paper prices would rise to meet physical replacement costs, or physical premiums would collapse as demand weakened. They didn't state which outcome they expected, but they didn't need to. Their unchanged precious metals allocation recommendations spoke clearly enough. What did these banks see that retail markets missed? First, they had access to data invisible to most traders. Order flow from industrial buyers, vault movement patterns across continents, forward purchase contracts from electronics manufacturers and solar panel producers. This data revealed something important. Industrial demand hadn't weakened after the crash. It had intensified. Second, they understood the difference between price volatility and value deterioration. Price is what traders pay in any given moment. Value is what an asset is fundamentally worth based on supply, demand, and utility. The crash had destroyed price temporarily. It hadn't touched value. A senior analyst at Goldman Sachs, speaking off the record to a financial journalist, put it bluntly. Weak hands got shaken out. That's healthy for the next leg up. This wasn't callous. It was analytical. Markets need to eliminate over-leveraged speculation before sustainable rallies can develop. The January crash had done exactly that. Traders who couldn't survive volatility had been removed from the market. What remained were stronger hands, physical buyers, long-term holders, industrial consumers. Third, the banks recognized a pattern from history. Similar crashes had occurred in other commodity markets when leverage overwhelmed fundamentals. Crude oil in 2020, copper in 2011, natural gas multiple times. In each case, the violent price collapse was followed, after consolidation, by a return to levels justified by supply and demand. The timeline varied. The path was never straight. But the pattern held. There was something else the major banks noticed, something subtle but significant. During the crash, while retail investors were selling, certain other buyers were accumulating. Central banks, sovereign wealth funds, family offices managing generational wealth. These entities don't trade on emotion. They don't react to volatility. They operate on decade-long timeframes with mandates focused on wealth preservation and strategic resource security. Their buying during the crash suggested they viewed the collapse as opportunity, not warning. Morgan Stanley published internal guidance to their wealth management division in late February. The memo, later leaked to financial media, was revealing. It advised against recommending silver to clients who require emotional stability in their portfolio. But it also noted that for clients with appropriate risk tolerance and long time horizons, the current price represented compelling value relative to fundamental supply constraints. This was careful language designed to avoid legal liability. But the meaning was clear. For those who could stomach volatility, silver at $87 was attractive. Perhaps most telling was what didn't happen. Not a single major investment bank reduced their precious metals research team. Not one closed their commodities trading desk. Not one divested from physical vault operations. If they truly believed the rally was over, these cost-cutting measures would have followed immediately. Banks are ruthless about eliminating unprofitable divisions. Instead, several were hiring, expanding capacity, positioning for what they clearly expected would be continued activity in precious metals markets. The institutional message was consistent across firms. The crash was technical infrastructure breakdown, not fundamental value destruction. The supply deficit remained real. Industrial demand remained strong. Geopolitical fragmentation remained intact. And most important, the factors that drove silver to $120 in January were still present in February. They had simply been temporarily obscured by the chaos of forced liquidation. In a nondescript warehouse outside of Shenzhen, China, a problem was developing that most traders would never hear about. A mid-sized electronics manufacturer, one that produced components for smartphones sold across Asia and Europe, had placed an order for industrial-grade silver in early February 2026. The order was routine, 5 tons. Delivery expected within 2 weeks. They had placed similar orders dozens of times over the past decade. This time, their supplier called back with unexpected news. Delivery would take 6 weeks, maybe 8. The silver existed, but moving it across borders had become complicated. The manufacturer's procurement officer pressed for details. The supplier was reluctant to elaborate. Finally, he said something revealing. The metal is classified differently now. Different paperwork, different approvals. This wasn't an isolated incident. It was happening across industrial supply chains worldwide, and it revealed a reality that paper markets had completely missed. Silver wasn't just a precious metal anymore. It had become a strategic industrial resource, and nations were treating it accordingly. The shift had started quietly in 2024 when China officially classified silver as a critical material, the same designation reserved for rare earth elements and lithium. The classification seemed bureaucratic at first, but its implications were profound. Export restrictions were implemented. Not outright bans. Those would have been too obvious and would have violated trade agreements. Instead, China introduced a permit system. Exporters needed approval. Approval required justification. Justification was evaluated based on national strategic interests. The result was predictable. Silver that had once flowed freely across borders now moved slowly, if it moved at all. Supply that had been globally fungible became geographically trapped. This mattered because of a fundamental imbalance that had been building for years. For the 5th consecutive year, global industrial demand for silver exceeded mine production. Think about what this means. Every year, more silver was consumed than was pulled from the ground. The gap was being filled by above-ground stockpiles, existing inventories held in vaults, warehouses, and strategic reserves. But those stockpiles weren't infinite. The Silver Institute, an industry research organization, had published data in late 2025 showing the scale of the deficit. Industrial fabrication demand had reached approximately 1.1 billion ounces per year. Mine production was roughly 830 million ounces. The gap, 270 million ounces annually. Where was that gap being filled from? Recycling provided some. Investment liquidation provided more. But increasingly, the gap was being filled by drawing down existing stockpiles that had accumulated over decades. And here was the critical detail. Unlike gold, most silver consumption is irreversible. Gold gets made into jewelry and bars that can be melted down and reused. Gold recycles efficiently. The gold mined by Romans 2,000 years ago is still in circulation today. Silver is different. It gets consumed. Solar panels use microscopic amounts of silver that can't practically be recovered. Electronics use trace amounts dispersed across circuit boards. Once embedded in these applications, the silver is functionally gone. Not destroyed, but economically irretrievable. This meant the deficit wasn't just a temporary imbalance. It was structural, permanent, and compounding. A research analyst at Metals Focus, a London-based consultancy, explained it in a February interview. So we're essentially eating our seed corn. The above-ground stockpiles that took decades to build are being consumed at rates far exceeding replacement. The data supported this. COMEX registered silver inventories, metal available for immediate delivery, had declined 43% over the previous 18 months. This wasn't because investors were selling. It was because industrial buyers were taking delivery of physical metal and consuming it. The solar panel industry alone was driving enormous demand growth. Each photovoltaic panel requires approximately 20 grams of silver. Global solar installation targets for 2026 called for over 400 gigawatts of new capacity. The math was straightforward. That required roughly 3,000 metric tons of silver, just for one industry, just for 1 year. Electric vehicles added another demand vector. Each EV contains approximately 30 grams of silver in various electrical components, roughly twice the amount in traditional combustion engine vehicles. Global EV production was projected to reach 20 million units in 2026, another 600 metric tons of annual silver demand. 5G infrastructure build-out required silver for its superior electrical conductivity properties. Medical devices used silver for its antimicrobial properties. Advanced batteries and energy storage systems required silver compounds. These weren't speculative future applications. These were current, growing, irreversible demands on available supply. And then there was the vault situation. The Shanghai Gold Exchange, which also trades significant silver volumes, showed something unusual in its weekly inventory reports. Silver stocks had declined 17% since the January crash. But here's what made this significant. Chinese prices were trading at premiums to international prices. In normal markets, if local prices are higher, metal flows in from abroad to capture the arbitrage. Supply increases until prices equalize. It's basic economics. It wasn't happening. The metal wasn't flowing. The permits weren't being approved. The arbitrage opportunity existed on paper, but couldn't be executed in physical reality. A commodities trader in Singapore, speaking anonymously to a trade publication, described the situation. We can see the price difference. We can calculate the profit. We just can't move the metal. It's like watching money through a window you can't open. This was the physical foundation that institutional banks understood and paper markets ignored. The January crash had happened on exchanges where contracts were traded. But in warehouses, vaults, and industrial supply chains, nothing fundamental had changed. The deficit was still real. The consumption was still irreversible. The geographic fragmentation was still intensifying. A 5-year supply deficit doesn't reverse because traders got margin called. Physical reality doesn't care about technical price charts. And slowly, methodically, the physical market was sending signals that anyone paying attention could see. Premium expansions in Asia, delivery delays in Europe, permit complications in China, vault inventory drawdowns across exchanges. The paper market said silver had crashed and the rally was over. The physical market said something entirely different. It said the world was running short of available metal, and that shortage was about to become impossible to ignore. On March 3, 2026, a peculiar meeting took place in a conference room at a manufacturing consortium in Munich, Germany. Representatives from 17 electronics companies sat around a table discussing something that had never been a concern before: silver procurement strategy. Not pricing, not supplier relationships, procurement strategy. One executive from a major appliance manufacturer posed the question that had brought them together: what happens if we can't get the metal we need? This wasn't theoretical anymore. Lead times had extended from 2 weeks to 8 weeks. Premiums were rising. Suppliers were requesting longer-term contracts with price escalation clauses. The physical market was behaving in ways that suggested scarcity, even while paper prices indicated abundance. The group didn't reach conclusions that day, but they established something important: a monitoring framework, specific indicators they would watch, thresholds that would trigger action. They were preparing for scenarios. This same conversation was happening in boardrooms across industries. And it revealed how sophisticated players were thinking about silver's path forward, not as a single prediction, but as a range of probability-weighted outcomes. The near-term scenario, covering the next 3 to 6 months, was the most straightforward. Silver would likely consolidate between $75 and $90. Markets needed time to digest extreme volatility. After a 35% crash, followed by a $29 recovery in just days, consolidation wasn't just probable, it was necessary. This frustrated traders looking for immediate direction. But for industrial buyers and strategic planners, consolidation was actually preferable. It provided time to secure supply contracts at relatively stable prices. It allowed procurement teams to negotiate without panic. The probability assessment for this scenario, highest among all outcomes. But consolidation doesn't last forever, and what came after depended on which signals emerged. The medium-term scenario, 6 to 12 months, presented a fork in possible paths. If physical shortage signals continued intensifying, silver would likely climb gradually toward $100 to $110. Not in a straight line, not without pullbacks, but the direction would become clear. This scenario required specific conditions. Industrial demand needed to remain strong. Mine production needed to continue disappointing expectations. Geographic supply fragmentation needed to persist or worsen. And most critically, physical premiums needed to stay elevated or expand. Several research houses were already modeling this path. Standard Chartered published a note in late February suggesting silver could test $100 by third quarter 2026 if supply chain stress continued. Their language was careful, conditional, but their base case assumption was telling. The probability assessment for this scenario, moderate to high, increasing with each passing month of sustained deficit. The long-term scenario, 12 to 18 months, was where the $120 question became realistic again. But this wasn't about the price simply recovering to its previous peak. This was about a fundamental repricing based on physical market reality overwhelming paper market mechanisms. For this to happen, several factors needed to align. The supply deficit needed to compound over time, each year of deficit making the next year's shortage more severe. Industrial demand for green technology needed to accelerate as nations pushed climate targets. Geopolitical tensions needed to keep supply fragmented across regions. And perhaps most importantly, inflation needed to persist, making precious metals attractive as wealth preservation vehicles. Under these conditions, silver wouldn't just reach $120. It would likely push through to $150, possibly $170. The move would be driven not by speculation, but by industrial buyers competing for limited supply and investors seeking protection from currency debasement. A senior portfolio manager at a European pension fund, overseeing $30 billion in assets, explained his thinking in a March interview. We are not positioned for a price target. We're positioned for a supply crisis. If we're wrong, we lose some opportunity cost. If we're right, we're protected when others are scrambling. This was institutional thinking, not betting on specific prices, but preparing for structural shifts. The probability assessment for this scenario, increasing steadily with time, particularly if physical market signals continued their current trajectory. But there was a fourth scenario that few were discussing publicly, the explosive scenario. This one had no fixed timeline. It could happen in 3 months, or 18 months, or not at all. But if it happened, it would unfold in days or weeks, not gradually over quarters. The trigger would be simple: a delivery failure at a major exchange, COMEX or Shanghai or London, a moment when buyers demanded physical metal and the exchange couldn't provide it, when the paper promises exceeded the physical reality by a margin that could no longer be papered over. The probability was low. Exchanges have mechanisms to prevent this, raising margin requirements, limiting position sizes, encouraging cash settlement instead of physical delivery. But low probability doesn't mean zero probability, and the impact would be catastrophic to market structure. Trust in paper contracts would collapse overnight. Premiums would explode. Industrial buyers would panic. The orderly market would become disorderly very quickly. Traders monitoring for this scenario watched specific indicators. COMEX registered vault inventories, if these dropped below critical thresholds, delivery notices versus available supply, if demand for physical exceeded metal available, premium expansion beyond 20% in major markets, if desperation buying became evident, Chinese strategic accumulation patterns, if Beijing started buying regardless of price. These weren't predictive, they were diagnostic, signs that stress was building in the system. For business leaders navigating these scenarios, a decision framework emerged. Position sizing needed to match volatility tolerance. Silver in 2026 wasn't for those requiring portfolio stability. 20 to 30% swings could happen in weeks. Anyone unable to stomach that volatility shouldn't be exposed, regardless of long-term fundamentals. Physical versus paper exposure mattered enormously. Physical metal provided genuine supply security, but came with storage costs and liquidity constraints. Paper contracts provided liquidity, but carried counterparty risk, the very risk exposed during the January crash. Leverage was the critical variable. The January crash had proven one thing definitively: excessive leverage destroys even correct fundamental analysis. Traders who were right about direction still got wiped out because they couldn't survive the volatility. Zero leverage meant surviving any drawdown. Any leverage meant risking forced liquidation at the worst possible moment. Timeline matching was essential. Business cash flow needs versus market volatility had to align. A manufacturer needing silver in 90 days couldn't afford to wait for 12-month scenarios to play out. They needed supply security now, regardless of price optimization. The conclusion from institutional analysis was surprisingly consistent across firms. The January crash had eliminated speculation, but not fundamentals. Major banks' forecasts remained unchanged because the underlying drivers remained intact. Supply deficit was structural, not cyclical. Physical paper disconnect would eventually resolve, and history strongly suggested physical reality would win that confrontation. For the business community, this wasn't about predicting exact prices or timing perfect entries. It was about understanding that silver had transitioned from commodity to strategic resource. The transition came with implications for supply security, input costs, and competitive positioning. The question wasn't whether silver would hit $120 again. The question was whether businesses were prepared for what happened if it did, or if it went higher. Because in markets where physical reality diverges from paper pricing, eventually one market forces the other to adjust. And the adjustment, when it comes, doesn't ask permission.